Most retail traders only look at volume by the x-axis over time and never pay attention to where the volume truly is transacted on a price-by-price basis. Instead, they stare at candlestick charts, thinking that a different time frame or a different color combination on their trading view will help make them profitable and find them high quality trade ideas. The truth is, they lack crucial information that either makes or breaks the price action that they need in order for their trades to work out or not. Most traders who incorporate volume analysis into their price action analysis tend to have a much better time spotting high quality trades and avoiding bad ideas. Before I get into this video, I want to go over something very, very simple. For price to move, shares or contracts need to change hands. A buyer buys from a seller or a seller sells to a buyer. When the transaction is completed, it shows up on the tape. The volume goes up. Then, as a result of the volume being transacted, price will then move either up or down, depending on if the bid or the ask was hit. Now, this literally means that the price action on your candlestick charts will only happen when volume is transacted. Why should you as a trader ignore the most important piece of the auction process, the volume that drives the price action itself? If you want to truly gain a well-rounded understanding of the market and how it works, and enhance your strategy and your edge in the market, stop ignoring the data that creates the candlesticks in the first place, and watch and listen carefully to what I'm about to share with you. Get comfortable, get your pen and paper, take some notes. Before I jump into things, make sure you're following me on my Instagram at Bids and Offers. I post super valuable content on there, day-to-day updates, all kinds of recap reels and more. In the last video of the order flow series, I covered the fundamentals of auction market theory. I explained what makes a market, how markets move, and why they move the way that they do. In this video, I'm going to show you how to begin reading volume data on a price-by-price basis so that you can know where the big players in the market stand and be much better informed on what exactly is going on behind the price action itself. This series is about me diving deep into the methodologies and approaches that I use to trade the market auction process with a professional, consistent approach. By the end of this video, you will understand, number one, why price action is created and exists. Number two, how to read behind the candlesticks like a literal spy. Number three, how to read the volume data correctly to identify big institutions and big market players to follow. And number four, how to generate high quality auction-based areas of interest and key levels, and thinking like a well-informed pro trader with very simple volume tools. That's enough yapping for me. Let's just jump right into it. Over here, I have a 5-minute candlestick chart on my NinjaTrader charting platform. You'll notice that I have two different ways of displaying my volume data. Number one, the typical way that most traders understand and already know, volume by time, showing you each volume bar over a set increment of time. In this case, this is a 5-minute chart, so each one of these little blue bars represents 5 minutes of volume. Now, as you can see, this volume is totaled on the right, and if the volume bars are higher, that means that there was more volume done in that 5-minute increment than the last one. You understand that, it's pretty basic. What you may not be used to is this massive blue volume profile that I have drawn over this candlestick chart. I have the smaller one drawn here from this morning's pre-market consolidation, and I have a volume profile drawn from 9:30 a.m. all the way over current day's price action. If you have no idea what a volume profile is or what you're exactly looking at here, I want you to go back and watch the first episode of this series, The Fundamentals of Auction Market Theory. I'll put a link down below. That video will help familiarize you with the concepts and things that I'm talking about in this video. I want you to think of these tools as a when and as a where. The volume profile shows me where exactly in the price ladder the volume was transacted. For example, this large area of transaction here around 7,415 and this thin area of transaction here around 7,450. The volume profile shows me where the volume was done, and the volume by time shows me when it was done. I personally think that in my trading, looking at only this volume by time at the bottom of my chart has no impact and does not help me whatsoever in finding high quality setups and consistency in my analysis. I like using the volume profile because it shows me exactly where large players and institutions in the market accumulate their orders and where the market rejects and does not want to do business, like this low volume node right here, around these 50s to 57s. I want you to think of the profile as a heat map where the market did business and where it didn't. Now you're probably asking, how can I get access to this tool? How can I look at volume profiles? The first thing I'm going to say is that TradingView is not your friend. I would probably take TradingView and just throw it right out the window. TradingView is awesome for regular candlestick charts and regular price action charts, but the volume data is sorted by the tick instead of true market data showing you exactly where the orders were filled on a price-by-price basis. TradingView does not have high-quality data feeds that allow its profiles to reflect the true market tape coming from the Chicago Mercantile Exchange. You need to invest a little bit of money in software. Either get NinjaTrader for $100 a month or buy it outright for $1,000. Get Sierra Chart for I think $100 or $150 a month. Try out Deep Charts. It just came out. Really, really good platform. Try out ATAS or even Bookmap. I can get you 20% off if you use the link down in the description and use code BIDS. It's an awesome, versatile platform that shows you, number one, the tape, number two, the depth of market, all resting orders on the bid and the ask, and number three, it actually does include volume profiles and all sorts of extra volume data on the right side of the chart. These are all excellent options. None of them are free. If you don't want to spend the $100 to invest in yourself becoming a better trader, you have bigger fish to fry. So now let's get into some basic beginner settings for our volume profiles. This one that I have drawn here is considered an RTH profile. RTH stands for regular trading hours, from 9:30 a.m. Eastern at the New York Open until 4 o'clock Eastern at the New York close. This is when over 90% of the volume comes through the market, as most people participate in the New York session. There are multiple different ways that you can draw profiles. Number one, you can draw them by hand, specifically over different prices and different times that you have in mind. So for example, this profile that I have drawn here from 2:55 a.m. until 8:10 a.m. reflects all of the volume data by price shown over this exact time range, 2:55 all the way to 8:10, with a price range from 74.54 down to 74.34, about a 20-point range. I have my profiles on NinjaTrader here configured to show me the value area, which is 70% of the volume, about the mean, colored here in bright blue, and I have delta built into my profile, so you can see these red and green bars on the left here. Delta is something that I'm going to be getting into in the next video, so put that on the back burner for now. The way that I like to use my profiles is drawing an RTH profile from the 9:30 open over current market price and having a daily profile, so having a profile start at the beginning of the session last night at 6 p.m. Remember, the S&P 500 futures on the CME starts at 6 p.m. Eastern the night before and closes the next day at 5 p.m. The market is closed for 1 hour each day for maintenance. Again, I like to keep it very simple. I look at my profiles on a session time frame from last night to current day. I look at my profiles on an RTH time frame like this, starting at 9:30, just like that. And I look at my profiles on a select drawn time frame, so manual mode, exactly wherever I want to draw the profile. If you're just starting out using volume profiles, I want you to keep it very simple and only use one type, whether that be a weekly, a daily, or an hourly, or a session. Whatever it is, keep it simple and keep it consistent and learn to get used to the tool on your chart. Whatever works for you, works for you. Truly, there is no right or wrong. We're gonna get into some basic market auction logic. Like I said in the last video, the market is an auction. It trades up and down, constantly searching for the next willing participant to either lift or hit the market. To either lift the market or hit the market. There are both participants on the passive side and the aggressive side. In order for the markets to move, somebody has to be willing to lift the offer or hit the bid. Again, the market is a two-way auction. If you don't understand what I'm talking about and you are completely lost, please rewatch the first video of the series. Again, link is in the description. The market is an auction and it remembers the areas that it had an easy time transacting at and the areas that it had a difficult time transacting at. Large institutions often accumulate their positions in certain areas. For example, this area down here between 74.20 and 74.10 would be a very good example. This is called a high volume node, an area of the profile that is built out and has a lot of volume done inside of it. This area would be considered fair value, the market was happy to transact in this area before buyers were able to lift the market away from that area and do much more business upwards. Zones like these can often be viewed as consolidation areas, support, or resistance areas. To keep it very simple, what I want you to remember is that high volume nodes on one hand are areas where people are happy to transact, and low volume nodes, on the other hand, are areas where people are not happy to transact. These areas are very easily reflected in the profile like this: happy to transact, not happy to transact. I want you to pay attention to how many candlesticks are present in each of these areas. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, and so on in this area down here. So a lot of transaction, a lot of price action through this area. And this low volume node here between 74, 58, and 53, 2 candles. So the market only spent 10 minutes transacting inside of this low volume node, whereas it spent over an hour transacting in this high volume node down here. To keep it very simple, the market typically chops and consolidates through areas of high volume, and it speeds up or rallies or drops aggressively through areas of low volume, these low volume nodes. Often, prior low volume nodes from the previous session or previous day will become respected or built out on the current profile, where the market will tap into it and either immediately reject it and decide not to do any business still and respect it, or the market finds ease transacting there and the market is able to build out a high volume node in its place. Like I mentioned in last video, the market is constantly painting a wall. It's going to go back to areas that it thought it didn't cover up well enough and trade more there. It's going to miss areas. Some areas are going to be smoother than others. It's a constant work in progress, and the market is never done painting the wall. It's always going to go back and try and fill in the areas that it thinks is uneven, that it thinks is discolored. The auction process is here to facilitate every single buyer and seller's needs. Remember, the market would not be here and the candlesticks would not show up on our charts if there weren't buyers or sellers and people willing to lift or hit. A very simple concept and a phrase that you've probably heard before is that history does not always repeat itself, but it does often rhyme. In applying this to technical analysis, the way that I use this phrase to my advantage, especially with volume profiling, is that the market will usually respect the areas that it has respected before, and it will usually reject at the areas that it has rejected at before. These areas can be either high volume nodes, low volume nodes, value area ledges, or the mean, the VPOC, the volume point of control, the highest volume traded price in the entire profile range. For example, on this chart here, the highest volume traded price would be this big yellow bar at 74.62.5. This big yellow bar represents the most number of contracts that were traded today so far. This is going to be a very important level going forward because the market knows that there is a lot of transaction there and big players were happy to do business. These areas can often act as good support on pullbacks. They can often act as a flip level where once the market gets beneath it and fails to get back above, it can signal a possible change in the direction of the market. These areas are generally very important to be looking at. I already went over this in the last video, but this is a very basic graphic showing you the anatomy of a volume profile. This big yellow bar is the point of control. Usually you'll see the price action hanging around at that area and consistently coming back to it to revisit it and retest it. This blue dotted line is the value area high, and this blue dotted line is the value area low. This is the ledge of value. This means that most of the volume around this mean, this VPOC, was done between 69.57 up here and 69.42. This represents 68 to 70% of the volume, the one standard deviation about the mean. Statistically speaking, this area is very important as standard deviations can help us measure relatively where a single data point lies in relation to the rest of the set. When using this tool, I do not want you to marry any aspect of it into your analysis. It is a tool, not a cheat code. Shorting at the value area high and longing at the value area low is not going to get you anywhere. There are people out there that will tell you all you have to do is follow these levels and accordingly long and short at them. It doesn't work. Don't do it. What I want you to do is use this tool as a piece of context. Context is key in the market, especially if you want a trading strategy that's going to be able to persist through different market conditions and keep your edge long term. If you want to keep your edge long term, you can't use a tool that is only acceptable and only good in one market condition. You have to know how to use it versatilely and know how to use each of its contextual points to your advantage. Using this volume by price data combined with current order flow tape data will give your key levels and areas of interest much extra confluence. If you're in court, you want to present as much evidence in your favor as possible in order to beat the case. If you show up with no evidence, no lawyer, and no reasoning, you're probably going to lose. Why would you put a trade on that has no evidence and no reasoning and multiple different sources to back it up? Why would you pick a key level based off of only one thing? What I would do is pick a key level that is based off of multiple things. Maybe, for example, the previous day high, the previous day value area high, a big delta outlier from the previous day or earlier this morning or whatever it may be, a zero print, the volume point of control, a low volume node, a high volume node, whatever it is, it has to be significant and it has to make sense. And if you're looking at a specific price level, that price level will be more significant and more important if there are multiple tools pointing to that area and saying, hey, this is a price that multiple things are lining up at. It's something to look at. It's something to put emphasis on. I promise you that if you pick a level off of one tool and nothing else lines up and you have no other areas of confluence for that price level, it's probably not that significant and you're going to have a hard time pinpointing where you may be right or wrong on your idea. Typically, when I see low volume nodes form in the middle of a trading range, like this one here and this one here, these are areas of stair stepping where the market rallies up or in a downtrending bearish market drops down, pops back up, and fails. Think of it as tapping on the ceiling and then walking upstairs and jumping on the same floor that used to be that ceiling. That floor and that ceiling, that area that you can't physically exist in, is considered a low volume node. Most of the time, price will rally above it, pull back, and hold, and something on the order flow, on the options flow, whatever is creating the price action in the first place, remember, transaction, is going to either make or break that potential move. I want to get into some very basic trade ideas coming off of the profile. There are two main types of trades that I look for. Number one, momentum plays, to watch and see if the price holds on a pullback in the direction of the current trend that I can buy or sell to continue riding that trend. Number two is a mean reversion setup, a reversal setup, where I look for price to either pop up and fail above its recent range or sell off and fail below its recent range to trade the market back into its range, back to the mean, using mean reversion theory to my advantage. I want to focus on this little consolidation here from between 3:10 a.m. and 8:35 a.m. yesterday morning. What we see is the market popping up and rejecting around these 74.17s. It sells off and rejects at the same low that it had just made earlier here at 74.02. It comes back up to the high and again rejects. Now we have this box forming. We have a rectangle box where the market is being sold off at the highs and bought up at the lows. What I look for inside of this box is to see if the market is able to be supported at the lows and resisted at the highs. A typical mean reversion trade that I will look for has to have some kind of order flow confirmation telling me that either sellers are trapped or exhausted at the lows, or that buyers are trapped or exhausted at the highs. In order for a buyer to be trapped, there has to be excessive buying effort into a passive offer by a seller on the level 2, on the order book, where the buying is buying from the offer, but it's not moving the market up. One could call that absorption. The other thing that I look for is if there is no buying in the first place and the selling comes back in. That is a telltale sign that we may revert back through the center of the box. I look for good risk to reward trades with good order flow confirmations, with good contextual points to get in and out of in conditions like these. I sell the highs and I buy the lows. Does that sound too simple and too good to be true? Yes, it absolutely does. There is no right or wrong in trading. The people that tell you to stop using basic support and resistance, and especially the people that say, oh, supply and demand zones don't exist, it's all ICT, get lost. The market is always going to have areas that it is supported at, and it's always going to have areas where it is resisted at. There will always be floors, there will always be ceilings. Your job as a trader to build your account by taking winning trades and managing your risk is to identify repeatable setups that offer you good risk to reward and a decent probability of working out. Once you are in the trade, your job is to manage the risk around that trade. Watch what it's doing, see if you're right or if you're not right, and then manage your risk accordingly. Your job as a trader is not to predict every move, is not to catch home runs all the time, and is not to top or bottom tick the market. You need to find areas of interest that you can consistently and repeatedly identify and execute on. There is no holy grail, there is no secret, there is no cheat code. You have to have repeatability in your analysis. You have to have a way of creating the same ideas over and over and over again based upon different market conditions, different context points, but with the same evidence and data that suggests the trade may be able to work again long term. Anyway, I'm going to stop yapping. We're going to get into the momentum play idea. I'm going to draw this profile over a little bit further past the open about 45 minutes from yesterday, and you're going to see that this large value area, this high volume node where we have the most amount of transaction at 74.06, the market actually pops back up after the open and rejects to hold at this area. I'm going to give you multiple different context points for this area. Number one is the volume point of control from this drawn profile. You'll see that these previous supports down here at 74.03, 74.04, these areas where the market bounced earlier, the market is now underneath and is rejecting back into that area. This is a stair step down. The second contextual point is anchored VWAP. Anchored VWAP is sitting just a couple ticks above this last high and a couple ticks above these previous lows that occurred earlier that morning. The third contextual point lies in the order flow. Again, I'm not going to dive too deep into Delta today. We're going to get to that in the next video. But right in here, I want you to identify these couple red bars that stand out against the rest of these green bars. This big block of red bars signifies very aggressive selling into the bid in this area at this price. As the market comes back up to this 74.06, we have the highest volume traded price there all morning. We're now rejecting into that, and we're rejecting into this negative delta, and we're beneath anchored VWAP. What does this tell us? We may possibly have a very good risk to reward area to short a breakdown from. I know that if I short here, I can put my stop loss above this negative delta and above this anchored VWAP to get short targeting this low of day down here at 73.91. This is easily a 2.5 or 3R trade minimum. This is a momentum move with multiple pieces of context for your entry and a good invalidation point above that VWAP, above that negative delta. I'm not going to pull up the footprint chart right now, but I'm sure that on the footprint there is some instance in here that suggests the market auction process was leaning towards the seller's advantage as the buyers got overwhelmed into those 06s. I'm going to show you another entry opportunity right here. This is called the value area low breakdown. At 10:45 a.m. on this wick right here, as the market pops back up above the 73.94s where this value area low sits, notice how there's a lot of transaction up here and not a lot of transaction below that ledge. The market sells off beneath it, pops back up, and fails to hold above that value area low. This is another excellent area where you can look to short the market and put your stop loss back inside of value. You want a really, really good risk to reward ratio on trades like these because, remember, typically the market and all data itself in the whole world is going to want to revert back to the mean. You need a very good reason for the market to not do that if you're looking for the momentum move away from the mean, which means a lot of mean in here, lots of mean. I've said it like 8 times. You need a very good reason to sell the market here. Ideally, buy side absorption, ideally an exhaustion print on the retest, and ideally a ton of selling effort coming right back in on that turn of the tide. When you are trading momentum moves away from value, You need to see that aggression very, very present in the market. When you're longing, you want to see a lot of buying coming through and very weak selling on pullbacks. When you're shorting, you want to see a lot of selling coming through and a lot of weak buying or tracked buying on the pops up. You need to keep it simple. Don't overcomplicate it. Look for repeatable ideas. Look for repeatable confirmations. I have 1,000 videos on my YouTube channel on the confirmations that I use, so go check those out if you want. You need to have good risk to reward, and you need to have confidence in your decision in the moment. If you are guessing and you're gambling and you have no idea between your left and your right, and you just want to put a trade on because you want to see the P&L on your screen change, walk away from your computer and get in your car and drive to the casino. I'm sick and tired of people telling me that trading is gambling. Number one, if you have a system and an approach that you know works long term and a repeatability in identifying your ideas and your opportunities, you can successfully make a career out of it. I want you to note that the only pro gamblers that actually make a career out of gambling either play poker or card count. There is no in between. You cannot get rich off slots. The casinos are not built on paying people out. They are built on stealing people's money. The casino knows they have the house odds over you. The only way you're going to come out on top in a casino is if you have the math and have the proof that you can overcome their odds long term. That is why they ban card counters, and that is why most people lose money when they go to the casino. Because they know if they made it easy for everybody to have an advantage over the house, they would no longer have their casino. Why would you walk into the stock market, into futures, into options, whatever it may be, with no evidence of an edge, no evidence of a repeatable system, and just hoping for the best and saying, I'm going to become profitable. I'm going to get that strategy that's going to make me millions of dollars. Number one, show up every day. Number two, find a system that works for you, for your mind. If you're comfortable sitting there for 30 minutes looking for an idea, that's great. You're a short-term trader. You're a scalper. If you're comfortable with getting into a trade and holding it for multiple days, multiple weeks, okay, you're more of a swing trader. You have to understand where you're comfortable on the charts and where you're not. And then from there, what you have to do is execute and collect data on the trades that you take. What works? What doesn't work? Was this tool helping me in my trade? Was this tool just giving me brain fog and not giving me any extra context? Again, no specific tool, whether it's the volume profile or footprints or the bookmap platform itself, is going to make you excellent at your craft. What makes you excellent at your craft is combining the tools together that you know give you an advantage to see something that not everybody else is seeing in the moment. I'm sorry that sometimes I get carried away yapping about this, but I'm very passionate about what I do, and I'm passionate about helping you become the trader that you want to be. I'm going to go over some very basic mistakes that beginners may make while using these volume profiles. Number one, treating every level like support and resistance. Okay, I'm going to buy at the value area low. I'm going to sell at the value area high. Like I said earlier, doesn't work. Don't do it. You need to have other context points combined with that analysis to say, hey, maybe shorting at the value area high is a good idea, does offer good risk reward. I do have a good invalidation point for my stop loss. There is a reason on the order flow to revert and for me to get paid when the market moves away from my entry. Don't take every low volume node rejection. Don't take random trades at the VPOC just because you think the market's going to bounce off of it. The VPOC is the volume point of control. The point of control means that the market tends to hang around at it. If you're longing and shorting at the point of control inside of the chop, what makes you think the market's going to move away from that area? It very well can, but that clue lies within the order flow. Each of these positions on the volume profile are important, but none of them are more important than the other. They're all just areas of interest for you to combine with something else to give it a more robust, higher probability chance of being significant. All right, mistake number two that beginners make with volume profiles: ignoring trend context. If the market is rallying and you see that we're building out a P shape of a lot of volume at the highs, you say, oh, P shape, we must sell off. Guess what happens most of the time? If the market is rallying, it's probably going to keep rallying. What have we seen since the Iranian ceasefire? The market has gone parabolic, out of sight, straight up to the moon. We are trading at almost 7,500 on the ES futures. That is absolutely diabolical, and I had no idea it was going to do that. If you're trying to short at the all-time highs, it doesn't work, don't do it. You need to know where the previous day high and low are. Are we an inside day or are we an outside day? Are we trading inside of yesterday's range, or are we rallying away from it and pulling back and retesting the edges of yesterday's range? You need to know contextually where we are in accordance to where we have been. Using a previous day volume profile is very important because you can see where there was transaction and where there wasn't. If the market is currently outside of that previous day volume profile, I want you to put a little bit of emphasis on those ledges. Put a little bit of emphasis on those very sharp low volume nodes. Sometimes these areas are going to be excellent points where the market will break and continue from, or accept back inside of value. Again, the volume and the order flow tells you all you need to know about what's going to happen on the candlestick chart. The candlestick charts are a result of volume changing hands, of shares and contracts changing hands. Mistake number 3 that beginners may make while using volume profiles is ignoring the current order flow information and the current price action to prove one side correct and paid and the other side wrong and losing money. You need to have access to tape data. You need to have access to order flow data. I do know some very successful traders, especially some that make excellent YouTube videos, that trade very, very simple break and retest candlestick patterns, but most of their reasoning for entry on those setups consist of confluence across the board. So if there's trading stocks, okay, what's Apple doing? What's Tesla doing? What's Nvidia doing? Meta, Google, Microsoft, whatever it may be. Context points across the board. Where's the momentum going? Where's it pulling back? Are the previous day highs holding? But more importantly, pressing that button in the moment. They might just show the candlestick chart on the live stream or in the YouTube video that they're making, but most of the time, these really good traders are looking at the volume that comes through on the back end. Are the buyers getting trapped on the pop-up? What does the tape look like? Is it green or is it red? They have the volume data to help make their execution decision in the moment. They're not going off of candle wicks, I promise you. I do know some traders out there that are very successful off of using very basic price action and tons of confluence across the board. But again, the majority of them are using volume by price in real time to see who's getting paid, who is exhausted, and where the market is likely to return to next. Mistake number 4 that beginners may make is overcomplicating volume by price. Honest to God, you need to keep it simple. Don't overcomplicate it. Either use a daily profile, a composite profile with like a weekly or 3 days in it or whatever you want to use, or just draw them out by hand. It doesn't matter what you use. You just have to use the tools consistently with the trade setups that you're looking to identify. You can't go for home runs all the time, and you can't look for different types of ideas all the time with inconsistent tool usage. In my trading personally, I only look for about 3 different setups on the go. I'm not looking to catch every move. I'm not looking to hit home runs every single day. I'm looking to see if I have context points that are aligned, if I have a key area of interest that is being retested or being traded at that offers me good risk to reward on a potential move away from it with good order flow confirmation. And all of that has to be repeatable for me to be able to win long term. If you're just starting out using volume by price tools like order flow footprint charts and the depth of market and profiles and delta and all that, keep it simple. Use only one tool like the daily session or RTH session and just figure out what works for you. The only way that you're gonna find confidence in your trading is if you use your tools consistently and repeatedly the same way over and over and over again. Find out what works, find out what doesn't work, write it down, screen record your trades, talk to other traders, bounce ideas back off of one another, and take every loss as a lesson. There's a difference between a good loss, a bad loss, a good win, and a bad win. There are no shortcuts, there are no easy ways out. You have to show up, you have to put the time in, you have to figure out what works for you, and you have to improve upon it. That's gonna be pretty much all I've got for this video today. I hope that you took something away from this. If you did, leave a comment down below or a suggestion for something you want me to cover in the future. Make sure that you like this video and subscribe to the channel down below and turn on the notification bell so that you get notified when these videos drop. Make sure you're following me on Instagram @bidsandOffers. Stay tuned for the next video. Thank you for watching and peace out.